Hi, everybody. I'm Eric Bird, Vice President of Taxes, Zhang Financial. And I've got a mystery for you today. And no, it's not where is Rob McDougall. He's on vacation. We hope he's having a great time. The mystery I have for you today is a One Big Beautiful Whodunit. You know, this last year we've had a lot of changes with the tax laws. And so today we're going to explore that law. I'm going to introduce you some suspects that may be able to help save you some money, along with some red herrings about why maybe they're not the suspect for you. And at the end, I'll have you think about which one of them is going to be best for your wallet. So let's get a clue about the new tax law. Our first suspect, let's take a look at her dossier. It's Miss Scarlett Slash, and she is slashing tax rates. Miss Scarlett has made the low taxes that we saw with the Tax Cut and Job Act permanent. These are the rates that start at 0%, and then we have the 10, 12 up to the 37%. Historically, these are pretty low rates, and we believe that it's still a very attractive environment to do techniques like the Roth conversion, where you would pay taxes on your IRA now at these low rates and let that money grow tax-free into the future. And then when that money gets pulled out, it's tax-free. You know, we've got the debt that continues to grow at a pretty quick pace. And so we don't think that this rate can stay this low forever. So it wouldn't surprise us if sometime in the future, 4 years, maybe longer, these rates change. The downside here is it's going to feel the same. Your wallet isn't going to experience an influx of cash. So that's a problem with Miss Scarlett. Our next suspect is Colonel Golden Years Mustard, and he has a new senior deduction. Seniors will be excited about this. People 65 and older will be able to get a $6,000 additional deduction. This is on top of the standard deduction or your itemized deduction. It's on top of that bonus amount seniors typically get with their standard deduction. The downside here is there are phase outs. So for a single taxpayer starting at $75,000, it will phase out. And once we get to 175, that will be completely gone. For a married couple, it will start phasing out at 150,000 and be completely gone by the time you get to 250,000. This is only going to be good for the next 4 years. We had a lot of talk that Social Security was going to be not taxed under this new law. It turns out that's not the case. Social Security is still going to be taxable. The senior deduction was the solution for that. So it's not going to apply for everyone, but for many people, effectively, it will be like your Social Security is not taxable. Our next suspect is Professor Salty Plum, and he has some changes to the state and local tax deductions. Those are deductions on your Schedule A. Think about property taxes, estimated tax payments, withholding. Professor Salty Plum used to be so salty because that amount was limited to a $10,000 deduction, but that cap has been raised to $40,000 under the new tax law. It's good for the next 5 years, but then it'll revert back to $10,000. There is a phase out here too. It's going to start at $500,000 and be completely phased out by the time you get to $600,000. This is true whether you're single or married. If you decide to file separately from your spouse, thinking that you can get $40,000 benefit for each of you, that's not going to be the case. We're actually going to half that, and you'll only be able to take a $20,000 deduction. There had been a lot of work related to getting a flow-through entity tax for businesses to allow businesses to deduct tax payments and let that flow through to taxpayers. And we're going to find that that still is a valuable deduction for business owners that has not been eliminated under the new law. Our next suspect is Miss Peacock Philanthrop, and she has some changes to the charitable contributions. The first one is great news. There's a new additional deduction outside of the Schedule A for people who make charitable contributions. You can take up to $1,000 for a single person, up to $2,000 for a married couple. This is in addition to your standard deduction. So that's great news. The downside Miss Peacock has is that there's a new 0.5% AGI floor for itemized charitable contributions. What this is going to mean is that you effectively have to make 0.5% of your income as a charitable contribution before it's even going to start counting to your total overall itemized deductions. This is going to start in 2026. So if you have a high tax year this year, or you want to get the full benefit of charitable contributions, you may consider front loading your charitable contributions into 2025. You can do that through using a donor advised fund that allows you to make charitable contributions into this fund. And then you don't necessarily have to pass them on to the charity in the same year. You can pass those on in future years, but it allows you to take a bigger itemized deduction now in the current year. It also allows you to gift highly appreciated stock and not have to take the capital gain on your tax return. So there's a double benefit there. Another strategy that could be very helpful is the qualified charitable distribution. That's where we take money directly from the IRA, give it directly to the charity. That avoids both federal and state income taxes. It also avoids that haircut. Now, that additional $1,000, $2,000 deduction is only going to be for cash contributions, though. So you can't use those donations to Goodwill or stock contributions to qualify for that $1,000, $2,000 deduction. And no matter what kind of charitable giving you're doing, you want to make sure you have receipts. If you get audited, the IRS is going to want receipts. And any non-cash contributions you give over $5,000 in any category, you're going to need an appraisal. So just be mindful of how much donations you're claiming that you gave to Goodwill, because it could throw up a red flag for the IRS. Our next suspect is Mr. Green, and Mr. Green is gathering and bunching his itemized deductions. He knows that the high standard deduction that we've seen under the Tax Cut and Job Act has been made permanent. This high deduction has made it so many people have a hard time reaching that threshold where itemizing is valuable to them or worthwhile. But Mr. Green can combine deductions from different years effectively by accelerating tax payments that might be due next year into the current year, or like we were talking about with the charitable contributions, using a donor advised fund and doing a big contribution in the current year. That way, maybe he gets a big itemized deduction this year, but then next year gets to take advantage of that high standard deduction. The other thing that Mr. Green wants to be aware of is that there's a new overall itemized deduction limitation. And effectively what that means is that for people in that highest tax bracket, that 37%, they're only going to be able to deduct 35% of their itemized deductions rather than the full 37%. So keep that in mind for people in that space. Our next suspect isn't a suspect at all, but what game of Clue would be complete without a murder? And we find that there are a number of items that are going to go away after this year as a result of some of the tax law changes. The first thing that I want to talk about is the Affordable Care Act. The first item is actually up for debate in Congress right now. It's one of the main reasons that the government is shut down. What we will expect to see in 2026, if nothing happens, is as income increases, the credit people get for their insurance payment will fall off a cliff once people reach 400% of the poverty level. What had been happening was that credit would gradually phase out as income increased. So we're going to have to stay tuned to find out what happens to that. But as it is currently, once you hit 400% of the poverty level, your credit will completely go away, and anything you've received as advance payments will have to get paid back with your tax return. Another thing that we're going to see go away after this year are the energy credits. Those effectively are going to go away in 2026. And finally, the IRS is going to move into the 21st century and do away with paper checks. And so that means we're going to want to put direct deposit information on tax returns. The second phase of that is we're going to get further guidance about making tax payments to the government, whether that's with your return or with estimated payments. but soon we're going to find that those are going to be required to be paid electronically. I would advise that you go ahead and start making those payments electronically anyway, based on the state of the mail, and also with the government being shut down, who's to say how those payments are going to get applied. Our final suspect, last but not least, is Miss White, who saves for kids and grandkids, any kid in her life under the age of 18 with the Trump account. The way this works is a $5,000 annual after-tax contribution to this account. You're not going to get a tax deduction on this, but that money will grow tax-free until the child turns 18, and then they can pull those out for qualified purposes. Qualified purposes include education, first-time home purchase, training, or to open a small business. When that money comes out for a qualified purpose, it's going to get taxed at capital gains rates, and an 18-year-old will have access to half of that money. When they hit 25, they'll have access to all of that money for qualified purposes. And by the time they get to 30, they will have access to all of that money for any purpose. If you're pulling it out for a non-qualified purpose, it's going to get taxed at ordinary rates. We're also going to see that the government is going to give a $1,000 bonus for newborns between now and 2028, where the government will just automatically put $1,000 into kids' Trump accounts. If you were born before then, or if the child was born after then, you will have to open up an account. You can put money in there, but we can't put any money in any of the accounts until a year after this tax law was passed. So we're going to have to wait till next year to do any contributing to this account. Ms. White is going to want to be aware that there are other great savings opportunities for kids, and we're going to want to make sure we're thinking critically about what opportunity we use. If your primary goal is education savings, the 529 is still a great opportunity. You're going to get a deduction for state taxes. The money grows tax-free. And unlike the Trump account, it's going to come out tax-free for qualified education purposes. Another opportunity to save for kids is the Roth IRA. The caveat there is you've got to have earned income. And so if you've got earned income, that money can go in. There's no tax deduction, but it'll grow tax-free until person reaches age 59 and a half. And then the money can come out tax-free. Also, after the account's been open for 5 years, you can pull out basis for any reason without incurring tax. So consider which of those options makes the most sense. So those are the suspects that we think are most valuable to our clients. There are a lot of other provisions in this new law, and if you want to explore some of those, we're happy to do that here. But just to highlight the ones we talked about, we've got Miss Scarlett Slash, she's cutting tax rates. We've got Colonel Golden Years Mustard with his senior deduction. We've got Professor Salty Plum with the new raised amount for those SALT contributions on your Schedule A. We've got Miss Peacock Philanthrop, and she's got those changes to the charitable deductions, that new $1,000, $2,000 deduction, and also those pieces to be aware of on the Schedule A that have changed. And then also Mr. Green with his bunching strategy could be very helpful, especially if you've got more SALT deductions that you haven't been able to take advantage of in the past. And then we've got those savings opportunities for you too. And so just like in a game of Clue, we'll give you which answer we think is the most advantageous to our clients. And we think that here at Zhang Financial, no matter which suspect is for you, because you're using the team approach at Zhang Financial with our great investment team, our new legal team, and our tax team, we think that you're all winners. And if you are interested in exploring tax savings more, please reach out to your contact person here, and we'd be happy to discuss what we can do in terms of your tax savings and your portfolio. But for now, we'll call this case closed. It was great to be with you this week, and next week, Rob will be back to talk more about the market.